Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm your host, Christine Lee. Joining me are my co-host, CoinDesk Managing Editor of Global Capital Markets, Lawrence Luton, and Managing Director of International Content, Emily Parker. Good morning, Emily and Lawrence.
Good morning.
All right. Markets are looking a little flat this morning. Let's take a look at Bitcoin. The CoinDesk Bitcoin price XBX index currently at $43,879. Bitcoin is slightly up about 0.1% over the past 24 hours. The CoinDesk Ether price ETX index is at 33.69. ETH is also trading flat pretty much. And the DFX CoinDesk DeFi index is at 438 points, up about 0.8%. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, just globally as the leader in crypto news, events, and data. So, Lawrence, not much going on.
Not much in the majors. Some action you're seeing in some of the alts. You had Solana's up a little bit, thanks to some nice things said about it from Bank of America. Cardano's up a little bit, thanks to Coinbase fixing a problem with withdrawals, and also you had SHIB for Emily. That's up a bit. There was a rumor floating around it's going to get listed on like Robinhood or something, but. Yeah, other than that,
pretty quiet otherwise.
It's been flat. I mean, like, what else are you going to do?
All right. In the Twitterverse, there's a lot of chatter around Representative Tom Emmer. He wants to introduce some legislation that prevents the Fed from issuing their own CBDC. Emily, dive into it with some of your thoughts.
Yeah, I mean, it's interesting because we literally just had Fed Chair Jerome Powell saying don't expect a CBDC anytime soon, in not directly, but that's basically what he said. Even this report about CBDCs from the Fed that's supposed to come out is just going to be basically asking questions. So, China will see the launch of the CBDC in the Beijing Olympics. But as for this, yeah, it's interesting, but I don't actually think that this is a real threat right now that we're going to see a CBDC issued by the U.S. government.
Here's an interesting thread on that. And one of that being, since China is launching their own CBDC, he's concerned about surveillance tactics that could be used by governments. He doesn't want that to happen in the United States. And so it's an interesting tweet thread. If anyone gets a chance to take a look, I encourage you to do so.
The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
All right. Well, the internet was designed to be insecure, but we have a chance with Web3 to build a decentralized technology that presents a better alternative. And that's according to our first guest, a world-renowned cryptographer and privacy advocate. He is the founder of quantum-resistant digital currency Praxis and XX and distributed messaging platform Elixxir, which reflect his decades of research and contributions as the father of cryptocurrency. Please welcome David Chaum. Hello there. David, thanks for joining us. So you've written an article for CoinDesk where you state that if Web3 is to be more than a catchphrase associated with the vaporware of the metaverse, your words, that means rebuilding the internet from the ground up, something truly decentralized, truly protective of individual privacy and freedom, truly quantum secure, and truly democratically run. So let's dissect that. Who are the posers? Name some names, and who are the true builders of that future today? I feel like you hinted at some, but you didn't call it out outright.
Well, we actually, there are a number of chains and projects. There's been a lot of technology that's, I open sourced privacy and messaging about 40 years ago, and there's been a whole series of people. Tor is one of the more famous ones, but now in the XX Messenger, we've got a way that ordinary people can just use a messaging app to send their messages with privacy that's unlike anything else, because it hops through 5 different randomly chosen nodes from our 350 mainnet nodes. Each message randomizes it within a big batch of 1,000. So this is, to skip a little bit forward, Christina, the touch point for this kind of technology really has to be something that ordinary people can use right now. So when they switch to our messenger, which we're going to be launching shortly, then they'll be benefiting from all of the decentralized infrastructure without having to, do anything other than just switch messaging apps, which will be like painless. So that, this is something we've been talking about, like sort of like you were talking about CBDC and how it has to have privacy. All the studies show that. Well, it's the same thing with messaging and WeChat, and those are the two convergent mainstream things that ordinary people are going to be doing. And it's what I've said we would do several years ago, and we're just about ready to launch, is have messaging that is, with unprecedented level of privacy. No other messaging system has anything like the metadata shredding where it goes off top like we have, and integrated with payments. And, you have to have a quantum resistant blockchain infrastructure because only quantum resistant privacy is forever. So this is a critical aspect. I mean, it's a long. I was trying to just sort of move forward to the real interesting part of all this is, can we bring ordinary people into the blockchain space and to really immediately benefit from and use these technologies, because that's what's going to really grow this market. So we've been. I think. Yes. Go ahead.
No, we definitely want to talk about quantum resistant cryptocurrencies, but because that's obviously an incredibly important issue here. But before we do, I kind of want to touch back to.
Can I just say that it's not just the quantum resistant cryptocurrency, because that we have that in our wallets now, right. The quantum resistant backup. But also think about messaging privacy. Should maybe. Privacy is something that is essential for democracy. It's really the key ingredient for democracy, that people can talk among themselves without fear of being monitored. And so if that's something that they think will later be understood by AI and intelligence agencies and so on, you don't really have much of a basis for democracy. And I think that's what the world's really feeling right now. I mean, in a lot of sectors, this is a huge concern. Yeah, go ahead. Sorry.
Yeah, no, well, first of all, I did want to thank you for inventing pretty much all this and giving us all jobs. So
I was walking around consensus, the first consensus, and every second person was shaking my hand, and thanking me. Yeah, I made a lot of people rich. I did a lot of great stuff. I've been working on this for 40 years. Before the internet or anything, I was thinking, what's going to be the key thing? And it's democracy, it's messaging privacy, but you also have to be able to pay for news and be paid to generate news. Otherwise, the privacy in messaging is hollow.
So another person who's involved in messaging, Moxie Marlingspike, he did this piece the other day, and I've been asking different people about it, and I want to get your take as well. He's been very critical about Web3, and he sees a lot of failings because he sees a lot of centralization, that it's not really as decentralized. People don't want to have they don't want to have servers in their houses, so this is not going to work.
A lot of people feel that. A lot of people have been saying that, and some people have some, big powers behind them, like governments and stuff. There is no real true decentralization. I don't think it's the case. I mean, XX Network right now, we've got 350 nodes. People are running them in their basements, under their beds, whatever. This is not like people paying to run nodes in Amazon Web Services. We have as hardware spec. People have to build these servers. They have video cards in them, and we've got a community of people who really get this and have been backing it with their own, efforts over more than a year now. We've got a really good community of people, and this is we're in 80 countries.
Yeah, but what about the incumbents like Meta, formerly Facebook, which run half of the users on the internet?
Yeah, what about
who
them?
Run Instagram, Facebook, WhatsApp.
Yeah,
and they want to get into
what do they say, Christine? The bigger they are, the harder they fall. The thing is that we've seen it in messaging over and over again. Whenever one of these bigger dominant systems, because it differs per country which system is the dominant messaging system, because there's real network effect and economies of scale. So the dominant one, when the public finds out that they're giving the information to the government, or it's easily broken or traced or something, they just switch en masse because of the network effect to another messenger, and you've seen it over and over again over years. Or they'll switch to a new social media platform. We've seen things go from basically 0 to 50 million users in like 60 days globally. I mean, so it's, thank goodness these people have trained users how to use messaging and how important it is and so on. But now they've betrayed the public. The fact that they've been betraying it all along has become very well known. So people are ready. It's a powder keg. When you give someone a replacement product that's easy to switch to, which is what we have done, we'll do when this launches, it's over. Because whenever they're just, discredited and something else is found out, you get a wave of people moving over, and then you get a kind of network effect, and it builds out. So I think the biggest chance for democracy and for blockchain is getting our metadata shredding, quantum resistant privacy out there to as wide an audience as possible, because they'll be using blockchain without really suffering at all for it. And then, we can overlay on that, just like WeChat did, the sort of mini apps, you could do some payments and other stuff over this platform. And then you've really created the privacy protected spheres of participation in the internet that's really essential basis for democracy. And that's, absent that, we'll slide off into some other kinds of thing that, might not be as nice.
David, I totally agree with you philosophically about privacy being important for democracy. But, if we look at kind of what happened with Web 2.0, I mean, what you're saying didn't exactly play out, right? I mean, Facebook has had privacy scandal after privacy scandal.
Don't blame me, damn it. I published a Scientific American article.
Not blaming you, but just saying, like,
I hear you.
For this to actually work.
I've lived through this. I saw the NSA come in. I proposed that metadata shredding should be built into the fabric of the internet. That's the real end game. When they did the standards for the routers that created the internet, there's a guy named Steve Kennedy, paid by the NSA, came in and said, no, you can't. You must have the addresses in the headers. Every single message has to say exactly where it's coming from, where it's going to, right, and everywhere it's been. And you cannot change that. And that was built in to the standards of the internet, and next they try to revise it, and no, the government, came in and stopped that. But that's what's really needed. That should have been done. People in the space know that, but it's not like it's Web3. It's like they're big actors, like NSA, Cisco. There's a lot of people throw around a lot of weight, and they were very much against metadata shredding. But I proposed it in 1979, and I open sourced it.
Putting aside the NSA for a second, because that's a whole other thing. But, one thing that's important to bring up is that, like, a lot of the data that the NSA was using was coming from the platforms themselves, and the platforms had data that Americans willingly handed over, right? So I mean, that's, again, these are two separate.
And they're still doing it. It's unbelievable. And as people realize this, when you have an easy alternative, they're just going to switch. They're just going to switch. It's all about replacement products and easy cost of switching for the user experience. People don't want to learn how to use all kinds of new stuff or whatever, but if they could just switch, they'll do it. And that's what we're offering. And that's what's going to really, in my view, really amp up our whole blockchain space, which is which has other strong points. The way trading and financial transactions are done in blockchain, while nascent and a bit clumsy, and there's some bad examples, but it really has the. May I just finish my sentence? It really has the potential. I think this is an important other fact to bring in. It really has the potential to get rid of settlement risk and to make transactions clear immediately. And there is a just global systemic risk in financial services we're paying 3% of global GDP in fees for financial services. You can read about that. Look that up. It's startling, and what attacks on economic growth. But the blockchain does have the potential to eliminate that and to go to a real peer-to-peer system. But you need also the messaging to overlay on that.
But just following on Emily's point, I think what she was trying to say is, do people really care for privacy? Because sure, you can say they do, but they've shown that they've been willing to forfeit their privacy for convenience.
Well, they didn't know. They were tricked. But you're right. There is this, it's all, I've been in this privacy thing for decades, and there's always this question, if it's easier, people don't know how to protect themselves, they won't. If they could talk to more people, there's a trade-off that every individual makes. But it's not just an economic thing. It is the basis for democracy. But one of the key arguments or positions you'll hear from ordinary people is, who's interested in spying on me, and why would they take the trouble? And I don't have that much, and I'm not really that worried about it because I have nothing to hide. Well, it turns out that now, in an era where it's acknowledged that that the government is doing the full take, and that probably several governments are around the world, all this stuff is captured. They're storing it. They're building they're trying to build quantum computers. Who knows? Maybe they have them. Maybe they'll have them in 5 years. Who knows? When they do, and all the work in AI and machine learning, is going ahead. You don't see it. It's all behind the scenes. But when the confluence of those two trends is going to mean just everything that you have said in the past is going to be analyzed by AI for free. So you cannot no longer say, well, I don't know who's listening or who cares. And of course they care. They want to make money off you. It costs them nothing to have AI look at all of your communication, retroactively. And that's something that, unless you use quantum resistant protection, it will happen. When, we don't know. Yeah. And just the fear that is happening, and just the fear that people could use quantum computers to take down blockchains can have a really profound effect on people's, on the price of these things, and also on people's willingness to communicate their real thoughts. And it's a very serious matter.
There's an aspect that you brought up, particularly with regards to democracies. They're regarding voting in the United States, and there's some questions people are having in the long term about using blockchain technology in voting. Do you think that's possible, and do you think that it can be done in such a way in which it can't be manipulated, or have a quantum computer used by let's say a nefarious actor to change elections?
That's an excellent and very important question. And to answer it directly, I know the answer is yes. If you go to my website, chaum.com, and look at some of the voting work we did, we ran the municipal elections, the city of Tacoma Park, Maryland elections, 2009, 2011, by a publicly verifiable, and it was on blockchain technology, that the voters all loved it because there was a tracking number on each vote, and you could see that your vote was really recorded, but no one could see how you voted. And that type of system is very amenable to quantum resistant cryptography of the strongest type. So I would say definitively the answer is public sector elections can be done in a way that is publicly verifiable and quantum resistant. And now the XX Network is sponsoring VoteXX. You can see at votexx.org. We have developed a way to do voting outside of polling places where your vote, there's no real vote selling or coercion. Solving those problems is critical to allow voting to take place on a broader scale and more often, and in possibly different ways, using what we call sample voting, which is something I've also been very active in. And you can read about that on my website as well. So that there's we are pioneering this new type of totally decentralized election authority with quantum resistant voting security for the governance of our XX network. That we're developing these technologies. We also have a project called Seventh Estate, which is a way to people can use blockchain and paper mail to run their own public opinion surveys that are provably and publicly verifiably valid. And that's being tried. That's in the mail already right now today in Portugal, or that's the first use of Seventh Estate. So there's, just look it up, 7th.estate, if you'd like to read about it. So it's like, yeah, this democracy, the voting stuff I've been working on, I created mixing in 1979 for voting. But there's sort of like a couple paragraphs in that original article, which has been, my master's thesis cited more than 5,000 times. It's this kicked off this whole, mixed network thing. But voting was the actual reason that I came up with it, because it is central. And if these technologies will allow a much finer grained and more responsive kind of democracy than we've seen. So I think there's another shoe to drop in terms of the evolution of democracy, from the sort of this representative democracy, which, we've all seen its failings, to something that does a jujitsu move on AI. It uses AI to help us with voting while protecting us from voting, and can make it quantum secure. That's the kind of thing that I work on in my spare time. So
David,
watch this space.
David, it's fascinating. We're just running out of time, so I just want to ask one question that I think our viewers are going to be really interested in, given that you've been in this space for so long. Who do you think is Satoshi Nakamoto? Do you know?
Are you Satoshi?
Well, I look. That's look at my website, chaum.com, and read the article that talks about who invented all the aspects of blockchain, except for maybe the proof of work thing. It's kind of interesting. And look at eCash in the 90s. This was the first digital money, and it was in some sense better than the blockchain money, because when you had it, no one would know which one you had. Perfectly privacy protecting against quantum computers, even in those days. And no one could take your money from you. You could always be able to spend it. So this was issued by Deutsche Bank in Deutschmarks. It was in dollars, and we had our own Cyberbucks currency. So we a lot of the people that you hear about in this space came through, and they were visiting scholars.
Yes or no, David? Are you Satoshi? Yes or no?
Well, I'll leave that to you. But I had an awful lot to do with this, and a lot of people think that
won't even answer the question.
Send a few coins my way. Prove it. It's okay. Send some my way.
Move some of the coins, David. We want to see. All right, but you've also said that the most exciting cryptocurrency to you is Satoshi Vision. And are you talking about Craig Wright's Bitcoin Cash? If so, that's very controversial, but I'd like to hear your reason why.
Oh, no. I wasn't referring specifically. I mean, I think I count Roger Ver among my friends. And, I was there when, I think Vitalik jumped over the chairs and almost started to attack Craig Wright or something like that. Or was it the other way around? I was at that conference. I was in the front row. I was a speaker there, so I was hanging out with those people all the time and everything. I mean, I see what's going on in this space, but there is a lot of people talking internally, and there's a lot of stuff in the blockchain space that could be a lot better. And I think if we really take this to the public, a wider public, it's going to be a sea change and really move this.
But are you into Satoshi Vision?
Its real potential. Well, look, the Satoshi Vision is frictionless financial payments. That's what it says in the very first sentence of the abstract, right? And the original paper. So this is. This is a part of what XX Network has. We did 3,500 transactions per second, quantum resistant payments. We demonstrated it running for a full 10 days. It's all live streamed. You can see it. We will bring that back. So that's one aspect. Another aspect is you have to be able to protect your communication, including payments, but also your messaging. That we're launching very, very shortly. And it's
just
the integration
one more question, because we actually have to wrap up. This has gone over,
no, look,
but
I'm sorry,
if quantum computers are developed in the next decade or two, they could spin circles around the ones and zeros that support current computer networks. And so, if so, what does that mean for the current blockchain protocols we have? What does that mean for Bitcoin?
Well, I don't want to address Bitcoin specifically because I love Bitcoin, but all blockchain protocols that I'm aware of are, besides the one that we demonstrated, have a quantum could be taken down by quantum computers, either by stealing money from people's accounts, making transactions that weren't authorized, and or just breaking the consensus. And so we have built into XX wallets already a quantum resistant backup, and that's something that will give our XX network a non takedown security. But and once we have the quantum resistant consensus live, it changes things, because there is a race on to make quantum computers. Industry estimates are like 5 years. Look, I don't really care when it happens. And don't forget, governments are usually ahead. They will co-opt whoever is ahead because it gives them a tremendous advantage, and they won't announce it. You look at passenger ships were sunk during the Second World War, but the U.S. government knew it, but they didn't do anything because they didn't want to reveal that they'd broken the code. So who knows? Maybe some people have. But privacy is something that needs to be protected forever. So if you're sending around unprotected messages today, someday those will be readable. Those messages you send today will retroactively be readable. That doesn't give you the kind of confidence. That's when AI will be even more developed. Who knows what the world will be like then.
Right.
So what
David,
you really want to do.
Yeah.
Hey,
but
such
thank
a pleasure.
You so much for coming on the show. Oh,
we need another 3
absolutely.
hours.
The pioneer. Yeah, we need another 3 hours to finish this interview. But
another 3 hours.
The pioneer of blockchain research, the father of cryptocurrency, David Chaum, everyone. Thanks for joining us. All right, coming up, a group of U.S. banks want to create a stablecoin. We'll talk to one of the members, FirstBank, and that's coming next. Hi, I'm Christine Lee.
Zach Seward.
I'm Michael Casey.
I'm Christy Harkin.
I'm Isaiah Jackson.
I'm Serena Lynn.
Hey, this is Will Foxley.
I'm Teresa Santos.
Hi, I'm Lawrence Lewitton.
Hi, I'm Dorian Wayne.
I'm Nicholas Day.
Hi, I'm Kevin Worth.
My name is Naomi Brockwell.
I'm Jordan Muthra.
Hi, I'm Galen Moore.
Hi, I'm Brad Count.
I'm Pete Paschal.
Hi, I'm Jen Sanasi.
You're watching. And you are watching.
And you're watching CoinDesk TV.
Checking in on Bitcoin, the CoinDesk Bitcoin price XVX index is currently at 44,241. Bitcoin slightly up about 0.7% over the past 24 hours. The CoinDesk Ether price ETX index is at 33.87. ETH also making a slight advance of 0.5%. The DFX CoinDesk's DeFi index is at 440 points, making an advance of about 1.2%. Now, a group of U.S. banks are planning to deliver a stablecoin called USDF in a move to tackle concerns about the reserves behind non-bank issued equivalents. The group is made up of FDIC-insured institutions, including FirstBank. The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem. All right, joining us now to discuss is Wade Peery, Chief Administration Officer at FirstBank. Hello there, Wade. Thanks for joining us. So first of all, off the bat, since you're a crypto markets guest, we just want to get your outlook on how the crypto markets are doing. Do you see it going further up or a leg lower?
Well, I'd say we wouldn't speculate on crypto markets. It's really not our space and our business. So I'll leave that to the experts.
But all right, can you tell us about this bank consortium? Whose idea was it? Where in the process are you? Who will run the servers?
So it's been a collaborative effort between technologists and banks. Figure Technologies, New York Community Bank, of course, were instrumental in founding and really establishing the organization. And the view here is to really clear the way and do the foundational work so that the banks can unlock the value of blockchain. And if you think about the fact that blockchain is to our business revolutionary, and you look at the fact that underpinning our economy and our commerce systems are payment rails that are 40 plus years old, we get excited about the opportunity to revolutionize, and we'll take cost out of those things, speed things up, better customer experiences, and all those items that come along with it. So exciting times to be able to basically reinvent a foundational component of our financial system.
So wait, all the banks that are involved are FDIC insured, right? So how will this particular stablecoin be structured? Is it that your customers are going to go out and put money in a single account, or are they going to open up accounts that are then issued stablecoins against it, which are FDIC insured up to 250? What exactly is the structure from the user's perspective and from the bank's perspective?
Right. So if you think about it, we use the term stablecoin, but what we're really thinking about and talking about is a digital marker. So that digital marker represents on blockchain 1-to-1 $1, and a customer could deposit money into a depository account in an institution insured, and then have the ability for that institution to mint and issue a stablecoin, a digital marker, USDF, and transact business on blockchain. So yes, it would be in a relationship in terms of 1-to-1 with $1. So we won't impact the volume of currency. So it does flow strictly through FDIC insured institutions, which if you visit the President's Working Group report on stable coins, the recommendation coming from that was very definitive in the fact that they would like to see legislation and to the effect that they can only be issued by FDIC insured institutions.
So I guess my question is this, is that if I go into your bank and I open up an account at $300,000, or I put $300,000 in to get $300,000 worth of stable coins, $250,000 of that is going to be FDIC insured, or is it going to go into an account that is separate? In other words, my deposit won't be insured by the FDIC, correct? I'm trying to figure out how's that going to work exactly.
So your underlying deposit, yeah, sure. So your underlying deposit account is going to be no different than it is today. So that underlying deposit account is subject to FDIC insurance, and then therefore I use the term digital marker versus stable coin because that's just representative of that deposit account. So yes, we're making this function within the bounds of current regulatory framework.
So just to shift to the user perspective for a moment, there's so many private stablecoins out there. We're talking about these government issued CBDCs. What is the motivation for the user to have one of these bank issued stablecoins? Like how would it benefit them?
So I think you think about the stable coins in circulation today, and we don't necessarily think about those as competitors, but when you are issuing stable coin through an FDIC insured institution, you're also working within that supervisory framework. You have consumer protection in place there. You have stability, so you don't have to worry about things like run on a coin, for example. If certain stable coins may not be backed exactly $1 for $1. So in this case, they are. So I think if you think about the foundational real roots to our financial system, it really is the community banks. So as folks trust those community banks, I think we have created what will be a safer option for general use.
Wait, did you engage regulators prior to this announcement? Have you been talking to regulators about creating this stablecoin? And did Powell's testimony in front of Congress, did that affect when this was announced?
Well, certainly have had very deep dialogue with regulators and have been very proactive in that from that respect. And of course, what we are seeing in Congress and just different pieces of information we're gathering from legislators and regulators, regulatory agencies, certainly take that into consideration. But if you think through what happened in the fintech explosion in the last 10, 12, 15 years and how that all happened without banks really being a participant and without regulators being a participant as many things developed. This is a different approach in that we embrace a regulatory relationship. And so think about this as a collaborative work effort between technologists, bankers, and regulators to establish a very so we've had a dialogue with the OCC, the FDIC, Federal Reserve, all of those have shared time with us for us to present our idea and good feedback. So we'll continue to work very closely with those bodies.
And did Chairman Powell
Interesting.
today about CBDCs coexisting with stablecoins? Did that affect when this announcement happened? In other words, did you wait for the signals from Powell's testimony before coming public with this?
I would say the timing's more based on the fact that the dialogue we've had with the regulators and as we've rolled out, the functionality of this and the plan to work within boundaries. And as we gained acceptance from those folks, we felt comfortable going forward, not so much pinned to any particular event in time.
All right. Well, it's a big story, Wade. Thanks for joining us. Appreciate your insights. That was FirstBank Chief Administration Officer Wade Peery. Coming up, we'll talk regulation with international law firm Jones Day and CoinDesk's Nick Day.
Hey, I'm Isaiah Jackson, host of Community Crypto and author of Bitcoin in Black America. You're watching CoinDesk TV?
Seems every U.S. regulator wants a piece of regulating crypto. The SEC, CFTC, FinCEN, OFAC, OCC, US DOJ, and the IRS. All of them claim some authority to regulate digital assets. And our next guest says that is creating a DC dogpile of confusion. Joining us now is James Burnham, partner at international law firm Jones Day. Hello there, James. So DC is trying to figure out what to do with crypto, and maybe you can outline some of the problems in regulatory clarity that is befalling the industry right now with all these regulators trying to claim a piece of authority.
Yeah, thanks, Christine. I appreciate y'all having me on. It's great to be here. So I think maybe I just want to set the stage because a lot of the discussion about crypto regulation sort of feels like it happens in a vacuum. And people are just looking at whether this or that agency, what are they going to do? What's going on? What's the narrow thing? But the Supreme Court has changed the law governing federal regulators in dramatic ways in recent years that is really bad for regulators and really good for people who think there shouldn't be more regulation. And so what I mean by that is they've announced a rule basically that says major questions of legal policy and economic policy and social policy have to be decided by Congress first. And so before a regulator can do something, Congress has to clearly give it the authority to do that. And the best decision you can read on this came out over the summer. As you may recall, there was a moratorium that the CDC placed on evictions in relation to COVID-19. And the Supreme Court said the CDC did not have the power to do it because the statute they were invoking was very old and did not clearly give them power to regulate the housing market. So when it comes to the DC dogpile today, I think what people don't need to keep in mind is that just because the regulator says they can do it, or just because the regulator claims to have some sort of legal argument that gives them the power, that's not the whole story. And really Congress, what the Supreme Court has told us is Congress has to take the lead here. Regulators can't just do whatever they want using statutes from the Great Depression that include vague language that might arguably be applied to digital assets.
Well, it's interesting in the context, in September, the SEC threatened to sue Coinbase, and CEO Brian Armstrong slammed them for taking a regulation by litigation approach. But you believe crypto firms should actually potentially use affirmative litigation to push back on regulatory overreach and obtain a clear regulatory landscape that way. Can you explain, is this happening?
Yeah, no, absolutely. So it's never happened with the SEC. I mean, basically, there's two pieces to this. So if a battle is coming, you want to be the person who chooses the battlefield, right? You want to be on top of the hill, not at the bottom of the hill. One of the reasons the SEC has been so effective over the years is because they generally are the hunter, not the hunted. They are the ones who decide who to sue, where to sue, when to enforce, and how to do it. There are other contexts in which people have challenged laws and regulations before they are applied to them. And the basic theory of this is you shouldn't have to commit a crime before you find out whether what you did was actually a crime, right? So if you say, let's say you want to launch a token and you're concerned that the SEC is going to say that that's a securities offering. So if you launch the token, you've already committed the violation of the securities laws if they decide that it was a security and the courts agree. But you can there are ways you can sue the SEC beforehand. It's called a pre-enforcement challenge, where you can ask a court to declare that that it's not a security, that under the securities laws from the 1930s, the token offering that you want to launch would not violate them, would not fall within those laws, and therefore the SEC can't come after you. That is something that you could then bolster with the point I made earlier about the Supreme Court saying agencies have to have very clear statutory authority from Congress. The Securities Act is literally from the 1930s. And so the notion that Congress in the 1930s was saying anything about the blockchain or digital assets or even the internet is obviously just ridiculous. And so I think you would have pretty good sort of broad arguments that the narrow terms of that bill don't cover things that are happening, of that legislation don't cover things that are happening today in the digital asset space. And so the point, though, I think, is just that you shouldn't have to wait until they come for you. If you want, you can try to be more affirmative and go after them. Now, the details matter. It would be, it's very complicated to put these kinds of cases together, but it's something people need to think about, because there's no reason why we have to wait for them to come steal our lunch money. We should think about going and roughing them up first.
So, James, I don't know if you got a chance to hear Wade Peery's discussion with us from FirstBank regarding the launch of their stablecoin. He said that he was engaged with the regulators there, the FDIC, OCC, et cetera. So it sounds as if that at least there's some proactive involvement by regulators, obviously, in some amount of cryptocurrency creations. And my bigger question with that is, are we seeing now these regulators all jockeying for position, if you will, just trying to get as much territory as possible now before such legislation is written, so that when it comes time to go in front of Congress, they say, well, we already do that. Why don't you just solidify this in a law?
So Lawrence, that's a great point. I think that is absolutely right. So I guess I have two thoughts on that. First, you have to think about incentives, right? So a regulator, an enforcement entity, especially an enforcement entity. I mean, the Fed is not. It's not designed to be an enforcement entity, right? The Fed is the central bank. They run the monetary policy for the country. But the organizations that exist solely to go after people, to enforce the law, the SEC, the CFTC, the Justice Department, those are sort of the hammers of the federal government. And as the old saying is totally right, which is that when you're a hammer, everything looks like a nail, right? And so when you're the chairman of the SEC, if you're Gary Gensler or whoever, you have a strong incentive to do as much as you can during your time at the head of an agency. And that, to go to your point, means you have a strong incentive to try to be as aggressive as possible in pushing the boundaries of the law to bring new things into your regulatory domain. In my opinion, that is the absolute opposite of how regulation should go. Regulation by enforcement, regulation by people who have every incentive to push the limit as much as they can, is the absolute wrong way to make policy. And that, I think, is what the Supreme Court has been saying in these cases, is that regulators don't just get to go do things. Congress has to give them authority in advance. And so, and I think when you do that, humility and caution and trying not to cause more trouble than you've avoided are sort of the watchwords of the day. I mean, Congress has to operate by consensus. It's often in gridlock. That, I think, is more of a feature than a bug, because that means when things come out of Congress, generally, they tend to be more thought out than things that regulators just wake up one morning and decide to do. And so the key, I think, is just to make sure that you don't destroy products in the name of protecting their consumers. We all think consumers should be protected. Obviously, that's a good thing. But I don't think the best way to protect consumers is just to destroy the product that they want to buy, which is what
James,
overregulation can sometimes do.
Unfortunately, but so much substance in what you've given to us this morning. So appreciate you come on the show. That was
Thanks so much, guys.
Partner
Really
James
appreciate it.
Burnham. All right, time to check in with CoinDesk Global Policy and Regulation Managing Editor Nick Day. Hello there, Nick. So Coinbase is acquiring a derivatives platform. Tell us a bit about that.
Good morning. Yes, yesterday Coinbase announced it was acquiring FairX. They expect this transaction to be completed sometime in I believe the first quarter of 2022. So within the next 2.5 months or so. And it's just the latest crypto exchange to, try and acquire a derivatives trading platform. FTX and Crypto.com have both made efforts to do so. FTX acquiring LedgerX and Crypto.com acquiring Nadex. So it kind of feels like the next big thing here is a lot of these crypto exchanges are going to try and launch crypto derivatives products.
Does that, we're just talking about regulation. Does that ultimately kind of make it an interesting case where you would have more and more derivatives being launched, and so it creates that conflict between, is it CFTC or SEC that regulates crypto? Is that going to just make it even harder for us to distinguish the two and where that will fit in?
It's a good question. Might really just depend on, whether or not Congress acts here. The CFTC has always had jurisdiction over derivatives products, and the argument that the CFTC has made, to support its taking jurisdiction over crypto spot markets has been that, it has this oversight over Bitcoin and Ether futures, and therefore, it is the best position to kind of just keep an eye on the spot markets for those two cryptocurrencies. But, most cryptos are not going to have futures products launched on them. I imagine, we're going to be stuck, you're not stuck, but sticking with Ether and Bitcoin particularly for quite a while. So, whether or not this will expand the CFTC's jurisdiction or grow the SEC's jurisdiction, it's probably going to end up being kind of like one of those, very in-depth analyses that ultimately will have to go to Congress, and they might have to kind of make that decision.
All right, Nick, thanks for your update. That was CoinDesk Managing Editor of Gold Policy and Regulation, Nick Day. Don't forget to sign up for the State of Crypto newsletter on CoinDesk.com. That is it for First Mover. What a show. Thank you, Emily. Thank you, Lawrence. I'm your host, Christine Lee. Meantime, check out The Hash at noon Eastern and All About Bitcoin at 3 o'clock. You're watching CoinDesk TV. Next up, stay tuned for the daily forecast with Angie Lau to see what's happening in the Asia crypto markets.
Welcome to the Daily Forecast, January 13th, 2022. I'm Angie Lau, Editor-in-Chief of Forecast News, covering all things blockchain. Well, Hong Kong's Monetary Authority, which is the de facto central bank, has launched a public consultation after publishing new proposals for the regulation of crypto. We're going to take a look at that story and a whole lot more coming up. Let's get you up to speed from Asia to the world. Well, let's kick off with some of the top stories coming out of Asia today. First up, prosecutors in South Korea have demanded life sentences for 7 executives involved in a crypto scam. The 7 execs from the now-defunct V Global crypto exchange have been charged with swindling over 50,000 members out of their money by promising 300% returns on investments. Members were also offered a $1,000 commission for referring new users, and while users did receive some of the promised returns, it was discovered that those funds were taken from new users' deposits, much like a pyramid or Ponzi scheme. Prosecutors said the defendants have not made sincere efforts to recover the losses that total more than, get this, $1.8 billion, nor taken full responsibility for their actions. The verdict and sentencing are due on February 11th, and we will be keeping watch on that. Now, over in the northeastern Australian state of Queensland, an innovative project is using blockchain technology to improve water market supply chains. Now, more than 1,000 farmers have partnered with blockchain firm Civic Ledger to address water security and fair access issues by incorporating the Water Ledger trading platform into the state's Mariba Dimbula water supply scheme. Now, water supplies are vital to the region as it is a major producer of avocados, mangoes, and bananas. Water management is a critical policy issue in Australia that some experts say hasn't been a priority, despite the country frequently experiencing droughts and bushfires. You can find those stories and a whole lot more at forecast.news. In Hong Kong, plans for new crypto regulation are on the agenda. The Hong Kong Monetary Authority, or HKMA, is looking for feedback now after publishing a paper on options for regulating the sector. Forecast News' Timmy Shen has more.
The HKMA paper says emphasis has been placed on user protection in developing the proposals. It goes on to note that stablecoins in particular present risks for monetary and financial stability, as they have higher potential for becoming widely accepted as a means of payment. One expert told Forecast News that players in the industry have understood things would change for some time.
There is a move towards regulation, but I think they want to balance what you would call consumer protection and broader financial stability, as well as, the ability, in particular with stable coins, to manage and effectively drive monetary policy, but also not hamper innovation.
Quinlan says he thinks Hong Kong is making moves that most global financial centers will also make.
My broader view is Hong Kong seems to be positioning itself as an institutional crypto center, right? Something where the regulatory environment is mature, the products are mature, the actors are fully compliant, have all the relevant licenses.
The HKMA says it is looking into whether stablecoin issuers should be regulated under the banking ordinance, and Hong Kong isn't alone in going along those lines.
There is a trend, at least at the discussion level, to move towards bank or bank-like regulations for stablecoins.
Indeed, Malcolm says the US is another example of a country where this is being considered. The consultation is open until the end of March, with the HKMA expecting to formulate a plan by July this year, and for the new regime to be in place by 2024. For Forecast News, I'm Timmy Shan.
Well, the New Year's slump in cryptocurrencies has been grabbing headlines, and while it might be hard to see any silver lining amid all the gloom and doom talk, is it time to build fresh positions? Michael Wu, CEO and founder of Amber Group, joins me to weigh in on this new economy. Great to see you, Michael.
Thank you, Angie. Great to see you too.
All right, okay. Whoa. Major digital currencies, whether it's Solana, Ether, Cardano, and of course Bitcoin, among many others, Michael, they've had a rough start to the new year. This has got a lot of people questioning the stability of crypto. But do you think this decline is instead an opportunity to build positions and portfolios? What do you think?
I think we will more or less understand that this particular volatility and near-term sell-off is driven by Fed's increasing hawkish stance. They are more likely to hike rates for multiple times this year, and all of that, of course, affect all asset prices, including crypto. Now, with that said, I do think if we do see a further sell-off from here, let's say Bitcoin go down to, say, 30 or 35,000 levels, or Ethereum below 3,000 or below 2,500, or around 2,000 level, these are great levels to start building more and more Bitcoin and Ethereum positions, or add onto your existing positions in a what I call almost like a risk neutral kind of way. Now, with that said, I do not recommend what we would typically call catching the falling knife in trading terms, which means do not go too crazy. Just take your time, level your bids, or wait until the market stabilizes at a favorable level and start to build your positions over time.
Yeah, catching a falling knife is a dangerous hobby, but for someone new to crypto, and for those who are starting the new year trying to think about portfolio diversity, how should one think of digital instruments and products as basis risk appetite? There are some EFTs tracking crypto, yield-bearing products, etc. What are some of the things that could be considered here?
Oh, I think you have much better options out there with our platform, Wealthy. You can simply come onto the platform. I think for, like you said, a lot of folks new to crypto or with less previous finance or crypto knowledge, stay to the basic and start with a simple portfolio of, let's say, half in Bitcoin, a quarter in Ethereum, and some in dollar stablecoins, or one your favorite blue chip coins, and park them for interest, so that over long term, not only do you gain from the value increase in these assets, but also you enjoy an attractive yield, compounding yield, by parking them on the Wealthy platform.
But of course, for fear of talking the book and giving people some
kind of specific investment advice, which we are not doing, by the way. Broadly speaking, what should people be thinking about in terms of risk? Why is diversity important? And, you know, to your product and so many products out there that provide really a plethora of choice, how do you think about making those decisions? What are the things to think about?
There are a few principles that you can never go wrong with, right? The first one is never risk more than what you lose. This means do not take on leverage unless you're very sophisticated and you really know what you are doing with leverage. And secondly, do not take on large investments that are out of your risk comfort zone. Set your monthly or annual investment budget or investment goal, have them grow from there. And then secondly, I think, stay long term. In the short term, there's always going to be volatility. Timing is always tricky. It's always difficult. Over long term, actually, the best investments look a lot more clear. The ones with best fundamentals.
Clear assets to hold, but of course we always have to do our homework in the new economy, and we appreciate your insights, Michael. Always good. And that's the daily forecast from our vantage point right here in Asia. For more, visit forecast.news. I'm Editor-in-Chief Angie Lau. Until the next time.